Hello, welcome to this lesson video on equipment fleet management. In this lesson, you will learn about the equipment fleet management information flows and processes, the different ownership and operation costs of a typical heavy equipment, and the differences between the options of buying, leasing, or renting an equipment. Let's use an example to explain the different financial and information flows that are related to owning and running an equipment. Securing an equipment for a construction job requires a lot of work behind the scenes. The shown figure tracks the early decisions and financial commitments for buying a new paver for a paving company. First, a decision to buy this equipment from the beginning is an important fleet management decision that's made based on the availability of current equipment assets, their utilization, and the prospects of future construction jobs. Buying the equipment requires securing a bank credit or loan that's used to create a credit account to fund the purchase of the equipment. From this credit account, the firm pays the dealer $78,000 to buy the equipment and $8,000 to buy the insurance policy to cover it against accidents and damage. By now, the equipment is ready to be dispatched to the job, which is done by a separate holding company that sends an invoice for transporting the paver to the site. During the utilization of this equipment on the site, the equipment yard staff of the paving company maintains the paver by fueling and lubricating it. At the end of the month, the paving company sends an invoice to the Department of Transportation, DOT, owning the project road, which it takes some time to review the work invoice and pay it to the paving company. During that time, the paving company pays the holding company for their first invoice and receive the second invoice like this. All this communication and financial processes are just shown for a single equipment in a single project for a single month. Imagine a company with tens and hundreds of equipment working in many construction project sites. Construction firms need well-integrated operations and fleet management platforms to help in delivering their projects in the lowest cost and highest quality possible. As such, equipment fleet management is an integral part of their project management system to provide the right equipment at the right time and place, so that work can be done at the lowest cost. Although it's a simple goal statement, but there is a lot of work goes into achieving this goal. An equipment management system should support the contractor in different equipment operation tasks like machine selection, financing, repair, tracking, logistics, training, and disposal. Especially in heavy construction firms, their equipment management system becomes the core for all aspects of their projects, like operations, site management, business management, and manpower. HCSS is an example of a software service company that developed a very successful suite of integrated project and equipment management tools that are becoming almost the dominant software for heavy construction firms. We can see how the different HCSS tools map to the different heavy construction business processes, including fleet management, equipment fleet management. Heavy bid is an estimating and bidding tool that's used by most heavy construction firms to develop accurate bid proposals. Heavy bid is well integrated with other software tools like Heavy Job and Equipment 360 to collect project and equipment actual data that become the real asset to create accurate future bets. Heavy Job is a project management tool for tracking equipment and manpower hours. Equipment 360 is used to track the equipment maintenance services and expenses. Fueler Plus is a tool to track fuel and lubricant uses. And HCSS Telematics is a tool to track and diagnose the equipment from distance. HCSS Dispatcher is an important tool to handle the logistics of deploying equipment, crews, and rentals to and from the site. You can see that a lot of the management tools are focused on equipment as they are important production assets in heavy construction projects. Let's switch gears now to see how the equipment hourly cost is estimated, which is a critical factor to consider when planning and designing construction operations. As we have seen in the earlier lessons, construction operations are designed to optimize its cost performance, meaning minimizing its unit cost that's calculated by dividing the hourly production rate over the hourly cost. So it's important to capture in that hourly cost all costs that relate to owning and operating an equipment. Let's check how to calculate the two main components of the equipment hourly cost, including owning cost and operation cost. The construction firm is burdened with the equipment ownership cost as long as the firm or the company has the equipment in its possession, regardless of how much the equipment is being utilized. This list shows the ownership costs that are not dependent on the equipment operation and utilization. Let's check each one of them. Depreciation cost is an ownership cost item that's charged to the construction firm as the difference between the purchase and salvage revenue. The purchase expense and the salvage revenue. Depreciation is a concept that crosses the border line between financial and economical modeling of the equipment as a company asset. This cost acknowledges the real annual bare cost of owning an equipment as the difference between its initial expenditure and end-of-life sale revenue. When the equipment is purchased, it costs as an asset in the financial book of the company and is initially listed with a value that equals the purchase price. The asset book then decreases over the years to reach the salvage value at the end of the equipment useful life. It's difficult to estimate the equipment expected useful life and salvage value, but it has to be estimated anyway for financial accounting purposes. There are two approaches to calculate the hourly depreciation expense that's part of the total ownership expense: the discounted time value method and the average annual investment method. For both methods, the cost of tires is deducted from the purchase expense as heavy equipment tires are really expensive, but they are still considered an operational expense. The first method utilizes the economic discounting method we learned from the previous lesson and from the engineering economics courses to be able to deduct the purchase and salvage cash flows that happen at two different times. We can add or deduct these two cash flows by calculating their annual worth or annuity values to be added on the apple-to-apple basis. Then this net annual worth is divided by the expected annual operation hours. This figure here shows an example that we can explain here briefly. This equipment has a purchase price of $78,000 and it is expected to be salvaged for $12,000 after 6 years. We will assume the tire cost is not significant and can be ignored. The negative annual work of the purchase price is calculated by multiplying the $78,000 by the A given P factor, as we learned from the previous equipment economics lesson. As such, the annual worth of the purchase price turns out to be 17,386. On the other hand, the annual worth of the salvage value is calculated by multiplying it by the A given F factor. So we end up with an equivalent positive annual cash flow of $1,594. So as such, the annual net depreciation cost will be the difference between these two annual values as $15,792. This value can then be divided by the annual operation hours to get the hourly depreciation expense. The average annual investment method is a simplified approach to calculating the ownership cost while approximating its portion of the cost of capital or interest. This method depends on calculating the AAI factor using the shown formula as a weighted average of the net purchase and salvage values, with the net purchase being the difference between the purchase price and the buyer's cost. Next, the annual cost of the capital, ACC, is calculated by multiplying the AAA factor and the interest rate I%. The annual depreciation D is used as the base annual ownership cost and is modeled following the simple straight line depreciation approach. This means that the net of P and S is depreciated equally over the years of the equipment's service life. Finally, the hourly depreciation cost is calculated by adding the base depreciation and the cost of capital and dividing the outcome by the number of operation hours per year. In some countries, including the US, the depreciation amount of the equipment can bring a lot of tax benefits. Taxes are imposed on the profit, not the revenue. This means that the more deductions you can claim from your profit, the more tax savings you will achieve. However, it's not realistic to deduct the large purchase cost of an expensive equipment from the taxes of the year when it's bought. As such, the tax benefit from purchasing a heavy equipment asset is achieved by deducting the annual depreciation of every year from the profit achieved in this year, and as such, lowering the taxable profit over the years. Let's check this example here where an equipment is bought and it depreciates $300 in the first year. The company's profit in the first year was $1.5 million, which means that the company would pay taxes of $300 if the tax rate is 30%. However, if we deduct the equipment the depreciation from the first year's profit, the taxes will drop to $240,000 and result in $60,000 savings to the company. Based on this calculation, the company will be able to claim their equipment depreciation in only the years when it makes profit. So some countries allow businesses to carry their depreciation allowances to future years to get more tax benefits. The next component of ownership cost includes the expense of making major repairs and overhauls to the equipment. Overhauling an equipment can mean rebuilding its engine or hydraulic system. These costs are not considered under the operation costs, similar to regular maintenance. So why is that? Because overhauls result in increasing the value of the equipment, while maintenance keeps the value of the equipment to follow the manufacturer expected depreciation. It's like upgrading a home to increase its market value versus just replacing the air filters for the air conditioning system. So the benefits of increasing the equipment value and extending its service life qualifies overhaul to be an ownership cost, not operational. Local government collect taxes on properties, including automobile and equipment. The taxes are calculated based on the book values of the equipment, which is why taxes are included in the ownership cost. Like automobile, firms also need to pay insurance premium fees to cover their equipment in case of fire, damage, and theft. These insurance premiums are paid as a rate of the equipment value to insurance companies. Some large companies manage their own self-insurance fund accounts, which can be feasible for large fleets and that are well maintained. The lost ownership cost is the expense of providing storage space for the equipment when it's not operational on construction sites. Most heavy construction firms maintain their own equipment yards that have the required secured space to store idle equipment. The expense of providing this space is included in the equipment ownership cost, but tracking its cost in a single overhead account and distributing it over all the company equipment assets. We learned so far about the ownership cost, which includes depreciation, overhaul, insurance, property taxes, and storage. Let's check now the operation costs. Operation costs are variable expenses that depend on the utilization level and operation hours of the equipment. So theoretically, an equipment will have zero equipment cost if it stays idle for the whole year. Let's briefly describe each one of the 5 main operation costs. Fuel costs can be calculated in 2 ways, the real data approach and estimation approach. The first approach depends on keeping a record of all the fuel consumed by the equipment and charge its costs as part of the operation expenses. This approach is more accurate and can even provide more insights on the equipment performance and health. The other approach is used in the lack of real consumption data by using fuel consumption estimates that are published by the equipment original manufacturer. However, this approach depends on making a lot of rough assumptions about the machine work conditions and applied horsepower. In addition to fuel, the equipment operation cost includes the replacement of some consumables that deteriorate with the equipment operation. The first category of these consumables includes items that are replaced following a fixed schedule that's tied to the equipment operation hours, which include lubricants, filters, and grease. The equipment service schedule will recommend replacing each of these consumables after specific operation hours. The equipment yard maintenance crew can follow the service schedule suggested by the equipment original manufacturer, or follow an in-house schedule that's developed by the company to consider specific quality standards. Minor repairs are performed to the equipment either on-site or in the equipment yard. The labor and material costs of such repairs need to be charged as part of the equipment operation cost. Remember, this is different than the major overhauls that are done to extend the service life of the equipment. Typically, the repair cost grows with the equipment usage and age. It's not linear growth. This is because more parts will require repair with the increase of the equipment age. Also, parts become obsolete for older equipment, which makes it harder to find and expensive to buy. For example, the U.S. Army found that 35% of its equipment maintenance cost was directly attributed to the oldest 10% of its equipment. The repair cost can be averaged over the equipment life or incrementally increased over the years. Tires of heavy equipment are really expensive. They are not like automobiles tires. The tire cost for some large equipment can be in the 5-figure range. And these tires have shorter service life than the cheaper retail consumer tires for passenger vehicles. Caterpillar, a famous equipment manufacturing firm, estimates the tire service life of one of its loaders to range between 3,000 and 6,000 hours of operation. This means that the tires will be replaced after around 1.5 to 3 years of normal single shift operations. Remember that the tire cost is deducted from the equipment purchase price when calculating the ownership cost, as the tire expense is allocated to the operation cost. The tire deterioration depends on the job conditions and the skills of the equipment operator. For example, that same Caterpillar loader will require replacing its tires after only 1,000 hours when it is mainly operated on surfaces of sharp rocks with full loads. Finally, the operation cost includes replacing some high wear items and that deteriorate at different rates with the job site operation conditions. These consumables include bucket teeth, ripper tips, rubber shanks, protectors, and truck box liners. These parts are replaced as needed and don't typically follow a fixed maintenance schedule like lubricants and filters. The decision to replace an equipment should consider balancing between its ownership and operation costs. Considering only the ownership cost, an equipment owner would prefer to keep the equipment until the end of its service life to minimize the average ownership cost by distributing its depreciation over a longer time period. For example, it doesn't make sense to buy a $1 million equipment and sell it the next day or month or even a year. The equipment typically drops most of its resale salvage value in the first years, so it's better to keep the equipment as long as possible. On the other hand, increasing the increasing operation cost of the equipment over its life justifies replacing the equipment as early as possible. So there is a balance point along the equipment service life, and it's the best time to replace the equipment as the total of both the ownership and operation costs will be minimal. This optimal replacement time of the equipment happens at the lowest total ownership and operation cost. Let's check this replacement analysis example. A small dozer costs 106 thousandths, and it can be salvaged at different values depending on how many years it was owned. We can see also that the maintenance cost increases with the years of its usage. Another input is the number of operation hours expected in each of its 5 years of service. The replacement analysis should consider the scenarios of keeping the equipment for 1, 2, 3, 4, or 5 years. Let's focus on the last scenario for using the equipment for 5 years. The depreciation cost is calculated as the difference between the purchase and the salvage values. Over the 5 years, the equipment will run for a total of the total of 6,850 hours. This means that the ownership hourly cost is $5.26, which is simplified here by dividing the depreciation cost over the operation hours without considering the time value of money. The cumulative maintenance over the 5 years will be $23,300, and its hourly rate is $3.40. So the total O&O, ownership and operation cost, will be $8.66 per operation hour. Looking at all the replacement scenarios, we can notice that the decrease. You can notice the decreasing ownership cost and the increasing operation cost. over the equipment usage years. In summary, we can conclude that it's better to replace the equipment after its fourth year of operation, which is right after receiving or achieving its lowest O&O cost. The replacement analysis is performed for owned equipment, but buying an equipment is not the only way to secure an equipment for the company operations. In many cases, it's better for the company to rent or lease the equipment. So let's see the differences between the cases of buying, leasing, or renting an equipment. Also, which cases are better to buy, to lease, or to rent an equipment. Renting an equipment is a better option for the cases of short-term need, low utilization, or trials of an equipment. The key factor here is the expected few operation hours that don't justify buying or leasing an equipment. However, renting an equipment is more pricey than the other two options of buying or leasing. Also, rental rate and equipment availability typically fluctuate over their seasons. The rental agreement will specify the repair and maintenance responsibility. Except for cranes and shovels, the renter is responsible for the maintenance of most equipment types. Heavy construction equipment can be rented on a daily, weekly, or monthly basis. The renting company assumes an average number of hours, operation hours for every rental basis. For example, the monthly rental translates into around 176 operation hours, assuming 22 work days per month and a single 8-hour shift per day. Most renting companies limit in their rental contracts the excessive use of their equipment beyond these hours. Let's see this calculation exercise to illustrate the break-even points between ownership, monthly rental, weekly rental, and daily rental. An equipment can be owned at an average annual ownership cost of $26,304. The same equipment can be rented for $30,558 per month, or for $1,182 per week, or for $369 per day. The rental hourly rate is figured out by dividing each basis rate over the number of involved hours. For example, the monthly rented equipment will have an hourly rate of $20.22 by dividing the monthly rental rate over the number of expected operation hours per month. We can see here that the continuous rental using a daily basis is more than double the cost of renting it on using a monthly basis. The rest of the table shows the break-even points for equipment ownership or different rental approaches. For example, the ownership break-even point is calculated here as the number of operation hours in a year to justify buying the equipment over renting it. For example, the break-even between ownership and monthly rental is 1,300 hours, is calculated by dividing the annual ownership cost over the hourly rate of monthly rental. This means that it's better to buy the equipment if it is expected to be used more than 1,300 hours. If the monthly rental option is not available and you have only the more costly weekly rental option, the ownership break-even annual hours will be 890 hours. Let's focus on the monthly rent break-even points. If the equipment is expected to run more than 120 hours per month, then it's better to rent it on a monthly basis. Following a similar logic, it's economically better to lease the equipment on a daily basis if it will run less than 26 hours per week. Lease is similar to rental, but follows a longer term of agreement with possible transitions into ownership. The long-term agreement is between the equipment owner or the lessor and the construction company or the lessee that will use the equipment, and it states the lease payment and length of the lease period. For the same equipment, it will cost the construction company less to lease it than to rent it, especially for long lease agreement. Also, the construction company's most benefit come from the fact that usually it's relieved from the equipment maintenance and repair, as the leasing company will provide the necessary servicing within the reasonable usage of the equipment. At the end of the lease period, the lessee or the construction company have three options: buy the machine at its fair market value, renew the lease, or return the equipment back to the leasing company. The utilization level is the main controlling factor in determining to buy, lease, or rent. This figure shows the visual comparison between the equivalent hourly cost of buying, leasing, or renting an equipment over different utilization levels or operation hours. The curve of the buy option follows the same trend of ownership cost curve that we have seen before. The lease option cost curve is always above the buy option curve. Leasing the equipment is always more expensive than buying, as the difference between them is the financing cost that is charged by the leasing company. The rent hourly cost is constant. It's the same regardless of how many hours you operate the equipment. The renting company will just keep counting these hours and charging them at the fixed hourly renting rate. The intersections between the curves are the break-even points between the buy-rent options and lease-rent options. For example, it's cheaper to rent this equipment if it is expected to run less than 42,000 hours a year. It's always cheaper to buy an equipment than leasing it, assuming that you have enough capital to invest in the equipment. Otherwise, leasing would be a favorable option against renting it if the equipment is short of cash or financing. This table summarizes between buying, leasing, and renting an equipment. Buying is better option for long-term uses of the equipment with high level of familiarity, when most of the company projects are in the same region with short transportation distances, with no use restrictions and taking advantage of depreciation tax savings. Lease is better option for equipment that are needed for shorter terms in remote projects with long distances from the construction company main territory, with immediate availability and low capital needs. Rent provides the same benefits of leasing at higher levels, much shorter terms, but at much higher cost rates. By the end of this lesson, I hope you now appreciate all the background work that's done to just secure an equipment for a construction project. Equipment economics and fleet management are key critical business practices to keep heavy construction firms profitable. Thanks for watching and enjoy the rest of your day.